And here are the crypto top headlines. JP Morgan debuts tokenization platform, BlackRock among key clients. Next, European regulator, DeFi comes with significant risks as well as benefits. Also, Binance rolls out self-trade prevention for spot and margin trading. Plus, SEC actively engaging with spot Bitcoin ETF issuers signals high likelihood of year-end approval. And Star Witness in SBF trial described living in a constant state of dread. Welcome to Crypto Top Headlines, where there's no clickbait thumbnails or titles, and no speeches on my opinions, just bringing crypto's news to you. We are a new channel here on YouTube and would greatly appreciate it if you would click on the like and subscribe buttons as well as the notification bell. It does help the channel, so thank you in advance for doing so. Now, on to these headlines. Our first top headline, JP Morgan debuts tokenization platform, BlackRock among key clients. The tokenized collateral network enables the conversion of traditional assets into digital assets and makes way for faster and more secure on-chain settlements. United States banking giant JP Morgan debuted its in-house blockchain-based tokenization application, the Tokenized Collateral Network, or TCN, on October 11th, according to Bloomberg. TCN settled its first trade for asset management giant BlackRock. The Tokenized Collateral Network is an application that allows investors to utilize assets as collateral. Using blockchain technology, investors can transfer collateral ownership without moving assets in underlying ledgers. In its first public collateralized trade between JP Morgan and BlackRock, the TCN turned shares of one money market fund into digital tokens, which were then transferred to Barclays Bank as security for an over-the-counter derivatives exchange between two companies. The first internal test of the TCN was conducted by JP Morgan in May of 2022, with a pipeline of other clients and transactions now that TCN is live. The TCN was launched to streamline and scale the process of traditional settlements on a blockchain. The use of decentralized technology made the process faster, more secure, and more efficient. According to Tyrone Labin, head of Onyx Digital Assets at JP Morgan, the new TCN platform unlocks capital and allows it to be used as collateral in ongoing transactions, boosting efficiency at scale. The platform enables the creation, transfer, and settling of tokenized traditional assets. It also allows for movement of collateral nearly instantly, unlike earlier methods. The blockchain platform allows clients to access intraday liquidity through a secured repo transaction using tokenized collateral rather than depending on expensive, unsecured credit lines. External clients who agree to the blockchain trade have their own node on which they can settle the trade and access other reports. The U.S. banking giant has come a long way from its early days of criticizing the decentralized world and is currently actively involved in testing and launching various blockchain and crypto-centered services amid growing demand. The bank used a blockchain-based solution to settle trades with Indian banks in June. Our next top headline, European regulator, DeFi comes with significant risks as well as benefits. The European Securities and Markets Authority released an article on decentralized finance and its risks for the EU market. The European Securities and Markets Authority, or ESMA, the European Union's Financial Markets Supervisory Authority, released an article on decentralized finance, or DeFi, and the risks it poses to the EU market on October 11th. In a 22-page report, the ESMA admits the promised benefits of DeFi, such as greater financial inclusion, the development of innovative financial products, and the enhancement of financial transactions, speed, security, and costs. However, the paper also highlights the significant risks of DeFi. According to the ESMA, the first is liquidity risk tied to the highly speculative and volatile nature of many crypto assets. The authority compares the 30-day volatility of Bitcoin and Ether with the Euro Stoxx 50 index, with the cryptocurrencies being on average 3.6 and 4.7 times higher than the stock index. The ESMA doesn't believe that DeFi manages to avoid counterparty risk, even if, in theory, it should be lower or even non-existent due to smart contracts and atomicity. However, smart contracts are not immune to errors or flaws. DeFi is especially vulnerable to scams and illicit activities as it lacks Know Your Customer or KYC protocols, according to the ESMA. Another important source of risk for DeFi users, as specified in the report, is the lack of an identifiable responsible party and the absence of a recourse mechanism. However, currently, DeFi and crypto in general do not represent meaningful risks to financial stability, the report concludes. That is because of their relatively small size and limited interconnectedness between crypto and traditional financial markets. The ESMA pays close attention to the crypto market, releasing its second consultative paper on the markets in crypto assets regulations on October 5th. In the 307-page document, the regulator suggested allowing crypto asset providers to store transaction data in the format they consider most appropriate if they can convert it into a specified format should the authorities request it. Our next top headline, Binance rolls out self-trade prevention for spot and margin trading. Introduced in January 2023, Binance's STP functionality is designed to block the execution of an order if it would result in a self-trade. Cryptocurrency exchange Binance is scaling its tools to prevent unnecessary trading fees associated with unintentional self-trades. Binance will fully roll out the Self-Transaction Prevention, or STP, function for all spot and margin trading users on October 26th, the firm announced on its blog on October 11th. Following the integration, the Expire Maker STP mode will be the default mode for all trading pairs and orders on Binance's spot and margin trading platforms. Once the STP feature is live, users will be able to check what orders have expired due to the STP function on the Binance official website, Binance app, and Binance desktop app through the transaction history page, the announcement notes. Introduced in January 2023, Binance's STP functionality is designed to block the execution of an order if it would result in a self-trade. The function targets application programming interface, or API, traders who set up specific programs to execute trades automatically with an exchange's trading engine. Self-trading occurs when an API user or a group of related users trade with themselves intentionally or unintentionally. The STP enables API traders to avoid accidental self-trading transactions, helping users prevent unnecessary fees associated with such transactions. Without STP, unintentional self-trading could happen in a competitive marketplace. For example, when orders from separate trading units of the same firm using the same unique UID with unrelated trading strategies happen to post orders that trade with each other, Binance said. While unintentional self-trading transactions are handled through STP, intentional self-trades are prohibited on the exchange. When self-trading is done intentionally to create an illusion of trading activity, it can be considered a form of market manipulation, Binance wrote, adding, Our market surveillance team actively monitors market activity to identify intentional self-trading and any other forms of market manipulation. Binance has extensive tools to track intentional self-trading and investigate offenders. As previously mentioned, Binance integrated the STP feature for USD margin futures on API in August of 2023. The STP function is optional and only takes effect when users enable it, Binance noted. Our next top headline, SEC actively engaging with spot Bitcoin ETF issuers signals high likelihood of year-end approval. The unfolding situation with the Bitcoin spot ETF has reached a critical point, with open letters from Congress ramping up pressure on the SEC and recent developments from BlackRock indicating positive news is on the horizon. Bloomberg's senior ETF analyst, Eric Balchanas, has gone on record stating the fact that SEC is actively engaging with spot Bitcoin issuers on their current applications, which hasn't ever happened before. We think a rejection is unlikely and hold a 75% chance of approval by the end of this year. This is noteworthy because for the first time, the SEC is actively engaging with applicants. Further bolstering the view of imminent approval is Stephen Schoenfeld, a former executive at BlackRock, who estimated in a panel discussion that the SEC would approve spot Bitcoin ETFs in the next 3 to 6 months. This timeline falls between January and April of 2024, nearly aligning with Balchanas' predictions. Schoenfeld also noted that the SEC would likely approve multiple filings simultaneously to prevent any single applicant from gaining a first-mover advantage. Adding another layer of optimism is the recent legal win by Grayscale over its lawsuit against the SEC. The lawsuit centered around Grayscale's request to convert its Bitcoin trust into an ETF. The court's decision to compel the SEC to fairly consider this conversion raises hopes for other pending ETF applications. The contradiction of the Grayscale Bitcoin Trust discount this week also serves as a prelude to the October 13th deadline for the SEC's next move, which is likely to involve an appeal in the Grayscale lawsuit. Adding to the growing optimism, the potential approval of a Bitcoin spot ETF could act as a catalyst for a wave of institutional investment. Estimates suggest that up to $17.7 trillion of institutional money could flow into Bitcoin ETF products. This would dwarf existing futures ETF volumes and mark a critical point in the broader acceptance of digital assets. Provided the SEC's anticipated sweeping approval becomes a reality, the impact of this could be significant. It could not only redefine investment dynamics, but also spur intense competition among ETF providers like Fidelity, Skybridge, and Valkyrie. While the waiting continues, the recent positive indicators suggest that the approval of Bitcoin spot ETFs is not a matter of if, but when, with a highly optimistic outlook for the first quarter of 2024, just in time for the halving. Our next top headline is an update on the Sam Bankman-Fried trial.
The trial of Sam Bankman-Fried getting even more interesting today as his ex-girlfriend continues to testify, and we're getting some salacious details from Caroline Ellison's testimony and her time running Bankman-Fried's hedge fund. Let's get to Kate Rooney outside the courthouse. Hi, Kate.
Hi, Tyler. So Caroline Ellison described what she called living in a constant state of dread. Every day, she said she was worrying about not being able to meet customer withdrawals from FTX and that everything would come crashing down at some point. In order to plug a hole that FTX had, Ellison says Bankman-Fried at one point was trying to raise money from the Saudis, in particular Prince Mohammed bin Salman, MBS as he's also known. At another point, Ellison says that Alameda executives paid a $150 million bribe to the Chinese government to unlock some accounts they had on a Chinese crypto exchange. Before they did that, guys, they tried to use fake accounts to withdraw some of that money. Those accounts, she said, were actually Thai prostitutes. You heard me right. There was an employee who pushed back on SBF around all of this. He allegedly told her to shut the F up in a meeting. He was also known for some of these types of outbursts in stressful situations, according to Ellison. Some details about the relationship as well today. At one point in the Bahamas apartment that is now infamous, Ellison saying that Bankman-Fried confronted her about the financial mess. He said it was her fault, said that she didn't hedge early enough, and that she got very upset. She said she started crying. She also talked about his image that he tried to cultivate, tried to frame himself publicly as an intelligent and somewhat eccentric founder. The Toyota Corolla that he drove, she said, was completely for PR optics. Apparently he had another backup car. She later made a list of things while she was running his hedge fund called Things Sam is Freaking Out About. That included getting regulators to crack down on another competitor, Binance, in order to improve market share. And then, guys, buying the company Snapchat. That was apparently on the table. Also was worried about potential bad PR for the company in the next 6 months or so. There was some awkward tension between those two in the courtroom today. When she was testifying, Ellison would not look at Bankman-Fried, avoided his eye contact completely. He looked stressed. He never looked at her directly. Finally, Ellison described Bankman-Fried as what she called utilitarian, said that he didn't think lying was wrong if it was part of a bigger goal and that the means justified the ends somehow. The defense will get a chance to cross-examine Ellison as soon as today, but she's back on the stand right now. Back to you guys.
So this concludes our top headlines. If you haven't already done so, don't forget to click on the like and subscribe buttons, as well as the notification bell. Also, leave your thoughts in the comments and share this video with your friends and family. Thank you all for watching Crypto Top Headlines, bringing crypto's news to you.